to the people who are supposed to benefit from the charity. Right? I want to just make a very small deviation and just to have you contrast the difference between savings and investments. Right? And savings may be, let me put this way, I want to put it properly. Savings are not investments, but investments are savings. Okay? And where I want to differentiate this is that your savings tend to be able to meet your short and medium term objectives, and investments are for medium to longer term goals. So essentially things that you save for are like a deposit on a home or vehicle, vacation travel. Typical investment vehicles for savings or vehicles for savings are your savings account, your term deposits, although there's not a lot of difference between the rates on the term deposits and the saving accounts right now. Money market mutual funds, and sometimes some other types of mutual funds, like your maybe a dividend fund or a mortgage interest fund that provides a little bit of income coming off of those. Your treasury bills, and something that we refer to as corporate paper. Very few companies in Barbados offer corporate paper any longer. As I was growing up, several of the major stores or major firms in Barbados would take in what they call term deposits. And those term deposits were essentially short-term corporate paper, which was utilized to provide short-term financing to the business, but also provided a short-term investment with a reasonably good return, typically over the return on a term deposit than the bank. So for example, a few companies that used to use this would have been Goddard's Enterprises, K. Shepherd, Bryden's, that I can think of offhand. And typically someone who would be sitting on $10, $15, $50,000 would advance the money to the company, and they would get a reasonable return on it compared to what they would get to the bank. I believe when the Banking Act changed in the early 2000s, and the definition of financial institution was strengthened, this discouraged a lot of those type of companies from issuing corporate paper, because the alternative to do that now is really through a offering document, a prospectus through the Barbados Stock Exchange, if it's listed, or through an unlisted offering using the private placement tool that's available through the Barbados Stock Exchange. But it's something that we don't see at all now in the Barbados marketplace. Investments, your typical investments in Barbados are your personal residence. That typically is the one that would accumulate the most wealth by the time that you are ready to retire or prior to your retirement. Rental income property, if you can afford it. A personal business, things like whole life insurance, your pension plans, and your mutual funds, particularly mutual funds that are classified as balance funds, equity funds, mortgage funds, or the typical long-term mutual funds that I would class in your investment portfolio. And then, of course, your corporate and government bonds. Again, very few companies in Barbados have actually issued a corporate bond. Almost all the bonds in Barbados are government bonds and debentures. And then, of course, equities, which are things that are traded on the Barbados Stock Exchange or the various exchanges in the region, or if you're fortunate enough to have access to trade some on or own some on the US or Canadian exchanges. So for example, about 2 years ago, 2 years ago, Sagicor delisted from the Barbados Stock Exchange and listed on the Toronto Stock Exchange to increase its ability to raise capital, but they also translated in the ability for Barbadians to have access to greater liquidity to sell their own shares through the TSE, right? Halam, good afternoon. I see your question. The question is, what investment options offer an opportunity to be or earn more than the current rising cost of living? Do you have experience in returns on trading or investing in cryptocurrency? Thank you for that question. Right now, the two things that will always beat inflation over the long term will be investment in equities and investment in real estate. Those are the two items that have the highest risk and return in the profile, but they also have the lowest liquidity. They're the most difficult to sell, particularly in the Barbados market. And I think, Luther, you can bear this out for me if you're still on the line. Real estate in Barbados has a very long tail in terms of being sold. The market is not as liquid and as aggressive as you would see in North America, where you will have a typical real estate sales and purchase season, which is between spring through to fall, early winter. I want to speak directly to cryptocurrency. I don't particularly like cryptocurrency. And the reason why I don't like cryptocurrency, generally, most of the cryptos in the marketplace are not asset-backed. If you have an asset-backed crypto token, for example, that is backed by something like real estate or backed by an underlying portfolio of equities and bonds and whatnot, it is an effective tool. But the reason, the rationale, or my rationale for not being comfortable with cryptocurrency was that I was living in Canada between 1998 and 2001, which was during the dot-com boom. And during the dot-com boom, we saw a number of dot-com companies that were the next latest thing in the marketplace. And the fundamental issue behind all of these was that they either had no revenue or no cash flow, but the valuations were significant, right? And the first test of the market, in 2001, 2000 to 2001, they collapsed because they did not have the underlying fundamentals of revenue, cash flow, and profitability, which are the things that drive the value of businesses. So classic example, I'm not sure how many may have heard of a company called 360 Networks. 360 Networks was a telecom company, and they were at the top of the tier of the telecommunications market. So in order for them to plan for production and procurement, they would go down to the next level of the second tier telecom company and say, give me, what is your financial forecast for what you're going to purchase from me, right? And then you go for one level down and another level down. So you start with, what happened, you started with inflated valuations and a very optimistic outlooks at the companies at the bottom, which fed into the plans 2, 3, 4, or 5 levels up to 360 networks. And when very few of those were actually realized, 360 networks and the second tier companies beneath it in particular collapsed because their customer base collapsed, right? Hallam, I hear you. But when I do valuations, I value things based on what I believe are the tangible components of it. I may join you for the session tomorrow night, but cryptocurrency is something that I am not comfortable with beyond the crypto being a token or a measure of exchange. But it's not something that I would recommend in terms of an investment, or if it's going to be an investment, it will be a very small portion of your investment portfolio, no more than 5%. Because from what I've seen, crypto has been very volatile, and there are not that many that actually have assets that really back them and support the cash flows and the valuation. All right, so I just want to slide into your pension estate planning, a short discussion on that. You should start planning for your estate and your pension from day one. The first day you walk on a job, or sometimes in terms of when you're planning to go to university, think about what your long-term objectives are in terms of what lifestyle do you want when you are retired. And this goes to the point that we made earlier in terms of maintaining your plan and also making your money work for you. What is your long-term objective in terms of, if you're 20, 24-year-old, where do you see yourself at 40? Where do you see yourself at 60? And where do you see yourself at end of life? So these are the critical things that you want to do when you start working. Start with your pension plan. I started working in 1983 at the accounting firm. I was very fortunate that my uncle was a life insurance agent at the time. But the first call I got was from an agent at one of the other competitors. And they called me and said, "Colin, come in, we want to talk to you about insurance." And he said to me, made a presentation and made a pitch to me, "Try this endowment plan," right? And I was like, you know what? I don't like it. I looked at the numbers. I looked at the investment. I looked at what the projected return was. And I said to myself, I'm not interested. I was actually 21. I'm really not interested in an endowment plan right now. My principal objective was retirement. So I want to see an annuity. I want to see a pension plan. And the response was, "You're too young to be bothering about pension." Okay? He failed on 2 points. One, this is what I as a customer wanted. And secondly, the long-term view is what is the customer's interest. I know some of the agents will get upset when I say this, but the differential in terms of what is presented to many customers by insurance agents is driven by more so their compensation and not necessarily the customer's ultimate need. Okay, that's my view. And I will tell you that's my view because I spent some time when I was in Canada actually designing insurance programs. So at the front end of actually designing the insurance plans in terms of doing the research and putting together what the compensation plan would be for the insurance agents coming out of how when they sell the plan. Okay. The second thing is when you start planning for your estate, the day you start planning the pension, right? Your estate is, what will my estate look like 4 years from now? Okay. I have some initial assets, which may be my pension plan, my savings account. I may have an insurance policy or two, but those are the basics of my estate plan. And the best way to do an estate plan is to write it down. So at the initial stage, you might just start by listing your assets, listing your liabilities, and then put down a series of goals. Buy a house within 3 years, buy a car within 2 years. Start I have a pension plan. I want to start a life insurance policy in 2 years' time with an X amount of value. I expect my beneficiaries to be, you may be married, you may not be. I may expect my beneficiaries initially to be my parents or to my siblings or niece and nephews or godchildren if you're not married. But your estate plan is essentially a living document. So in the initial stages, you should be updating your plan. And when I say plan, in this case, your objectives for your estate every 5 years. And as you get older, you start tightening up on what the objectives will be, because you have a much clearer picture of the assets you have, the liabilities that you have incurred, and much more clearer idea as to who you expect your beneficiaries to be. Okay? But your pension and estate plan are one and the same to a certain extent, because your estate plan includes the assets that will be able to generate income from you in your retirement, be it mutual funds, be it pension funds, be it the contributions from residential real estate income or income from business. So to a large extent, I treat pension planning and estate planning as part of the overall tool for your lifestyle and for where you need to be in your to meet your objectives. The other thing I just want to mention in here, and we're going to cover it a little bit when we talk about insurance, but your medical insurance plans is a subset of your estate planning. What are the things that you want to make sure you are protected for on medical insurance side if you happen to have a life event that can be debilitating or on a short term or long term? So when you craft your estate plan, pay attention to what your potential risks are. So pay attention to things like, what are my family risks that I have experienced, that have been experienced in my family? Should I be cognizant of the fact that there's a history of heart attacks or stroke in my family? Cognizant there's a history of dementia, or cognizant of the fact of one or more types of cancer. Those are the things that you need to take into account in that overall plan, because those are the things that will also drive how you allocate your investment into different instruments for protection. Okay. We're going to talk a little bit about insurance. All right. For me, there are three broad categories of insurance, at least on the personal lines. There's a life insurance, which is broken down between term, whole life, and endowments. You have your property insurance, such as vehicles, residential, and public liability. And then your medical insurance, basically your medical, dental, vision, your critical illness, your accident, disability, and in there as well, you can consider your short-term and long-term disability. But critical illness is something, given what your family history is something I think has become a much more important concern. Yeah. On the property insurance, what I would want you to be certain of is that you understand what is covered in your property plans, all right? And you will be surprised what if you really understand it, you understand very clearly the things that you're protected for. So public liability is something that sometimes we really undervalue because it is tacked on as part of the property insurance transaction. You say $500,000 in coverage, $1 million in coverage, but a lot of people do not actively take into account what that protection means. So classic example, a friend comes to your house, they slip. Your friends, you help them up, you say, I'm gonna pay your medical bills and whatnot. But you know, what happens sometimes is a week or two later, you may find out that there's a much more significant injury to that person. And this is where your public liability insurance comes in to play, because that can protect you from a significant loss of property. Because let's say, you know, that person has a major fracture and it costs $250,000 to fix. And the person is going to say, well, you know, Colin, you're my good friend, but honestly, you needed to make sure the step was fixed. I can't pay this $250,000, so I'm going to ask you to pay this $250,000. And the reason, even if I have medical insurance, once the medical insurance company has determined that it was an accident caused by a third party, even if they cover the benefit, they may come after the person who created the hazard. So either you're exposed on the personal side or you're potentially exposed on the insurer side, because the insurer is supposed to make sure they are made whole if there's a party who was negligent and has the ability to make them whole. Okay. The other thing that I found over time was the advice in some cases, you have a car accident, fix it yourself because your insurance premium will go up. And I know I have a few insurance agents on the call. I do not see the sense of paying $3,000 or $4,000 to repair a vehicle, right? Where the worst case scenario for me is that I may be at a 70% deductible. My deductible might drop back to 40% for 2 or 3 years. The change in the premium will never exceed the cost that you may incur by fixing that vehicle. The other thing, as some other agents will tell you, is that if the insurance company finds out that you've had a habit of having accidents and fixing the vehicles and yourself and not reporting it, they may drop cover from you because you're a risk, because they don't know when you're going to have a significant risk that they decide to present you with. But the fact of the matter, once they understand the profile of their customer, they will adjust premiums accordingly, or they might decide, well, let me help you do some additional training. There are a lot of things insurance companies can do to help you. Okay. I'm going to end with a classic situation I encountered back when I was living in Bermuda. And my son was riding on the premises. He was probably about 7 or 8 at the time. And he ran into my landlord's car, right? It did about $900 or $1,000 worth of damage. But because it happened where it happened, on the premises, my public liability policy component of my insurance cover responded. in terms of my property insurance responded to that claim. I had to pay not one penny in terms of that claim. So it's important to understand what you have. And if I can get one agent to clarify, and one thing for me is in some cases, you would find under your vehicle insurance cover, on the comprehensive insurance cover, if you're killed in a vehicle accident, there is a certain level of cover within that vehicle insurance policy that will pay for part of your final expenses. Okay. And in your medical insurance plan, if you happen to die or one of the other members of your family who's covered by that medical insurance plan dies overseas, there is usually a component for the repatriation of remains. So when you look at your insurance policy, really sit down with your insurance agent for them to explain to you what are the components of the coverage that you are entitled to. It is really important to do that. One of the other things that I will say that I've seen in some presentations or a few presentations on medical insurance, I have seen situations where persons have been advised, well, don't really make claims on your plan. The objective of medical insurance and its price accordingly is for what we call frequency, and in terms of the expected frequency of claims. So medical insurance policies are typically priced based on the expected the frequency and the claims value. Probably 80% of your medical insurance claims will come within a variable band, which the policy is priced for, so go ahead and pay claims. Again, if the insurance company finds out that you've had a number of procedures and tests done, which you have deliberately not reported to them, and an event comes out as a result of that illness or whatever that trigger was, the insurance company on review and on the claims adjustment may decide, I'm going to deny your coverage and I may cancel your coverage because you're not necessarily kept me fully informed as to the risks that I am undertaking, and that I will have the opportunity to reprice your policy accordingly with you, to take in account that we need to meet our own profitability goals, but also we want to make sure that you have adequate coverage. Okay. The other lines that I just want to touch on, I know I haven't touched on the commercial lines, are creditor life, creditor disability, and final expense. So some banks and other institutions you will find will offer you a creditor policy. Creditor meaning that you've borrowed some money from me, why don't you just take this policy and ensure the ability for you or your estate, well, basically your estate or yourself, to repay that loan in an event. So your creditor life policy is usually sometimes based on initial value of the loan or on the outstanding balance, and it will pay the value of the loan if you happen to die, right? What it does is that it relieves the necessity of putting up, let's say, a whole life insurance policy or term life insurance policy as additional security for the loan. And usually these are relatively inexpensive. So you may have a creditor product attached to a mortgage, to a revolving line of credit, to a term loan, personal loan or commercial loan. And typically that is usually quite cheap insurance. Although as you get older, it may become a little bit more expensive. But what it does is it is dedicated specifically to that loan. It is not, it stays outside of your estate, and it relieves the estate of the responsibility of paying that debt. The creditor disability normally comes in two flavors, short-term and long-term. Typically, the short-term insurance will only cover the interest component of the loan, because short-term disability usually is available for something like either only 3 to 6 months. And in that period, you're expected to recover quickly. The premium is not that expensive, but it will pay the interest component of the loan, and the bank will defer the payment of the principal once you've notified them that you are disabled or you're on short-term disability. These programs are normally administered by the bank in association with an insurance company. So the claim will go through the bank to the insurance company, so the bank is very much aware as to what is happening. Okay, long-term disability may pay the monthly amortization requirements, and this will be typically for anywhere from 1 to maybe 3 years. But once you're fully recovered and certified by the medical practitioner associated with the bank and the insurance company, the payments will cease, and then you will have the responsibility of paying the loan yourself until it's completed. The other one, which all of us should consider, especially if we're young enough, is your final expenses. And this will make sure that there's coverage for your funeral expenses, although some of the undertakers have payment plans which you can complete before that you can take out and pay over for, a few years, so that all your burial costs are covered directly with them. So you have the option of doing it here through an insurance plan, or you can purchase an installment plan with the undertaker directly. But both in either case are really truly insurance to a certain extent, because when you die, your estate doesn't have to worry about it. Okay. Someone made a comment just now that nobody's invited to her home because she has no public liability insurance. What I would suggest is that maybe go back and read your overall property insurance, and you may in fact find embedded in the property insurance document is that there is some form of public liability. Yeah. The other piece that I want to consider is that insurance could be a vehicle to use as part of your succession planning. Immediately, I'll answer that one question after this. So in terms of business succession planning, and it's one of the things that used to be recommended years ago with some of the accountants, particularly practicing accountants and whatnot, would be to pay insurance, buy a whole life or endowment type policy that would fund the estimated value of what the business would be valued at when you came to retirement age. Okay, so let's say you started a practice and maybe paid $50,000, you're running maybe $200,000, $150,000, $200,000 a year in terms of revenue. And if you were to sell that at the end of your life, or if it was saleable at the end of your professional life, it may be valued at $1 million, $1.2 million. So at the outset, and especially if you're young enough, we take out a policy, a whole life policy at $1.2 million. Okay, and when, or at least that would accumulate a cash value of $1.2 million at your projected retirement age. So rather than the business having to find the money to pay you its value, or you have to wait on the sale of the business or your partners buy you out, you cash in the insurance policy. And again, it is whole life or endowment, but a policy that accumulates a cash value. We may argue that it might not be tax deductible, but being tax deductible does not really matter, because the long-term objective is to be able to get, for you to exit your business with a substantial payment in your hand, especially if the business has done well. And then on top of that, you may be able to sell that the value of your share of the business and realize further rewards from that. But it's something that I would always say to a young person: if you're starting a business, if you think it's going to be your life work, make sure you plan using an instrument that will be able to cash you out, even if you cannot get the business sold, or if the terms and conditions on the sale may require you to wait for a payout. And this should be a cost to the company and not a cost to the shareholder. Okay. The question was just now, what's the difference between individual advantage or disadvantage of medical insurance plans or group health plans? Individual medical insurance plans, and I will tell you again from personal experience, if you can obtain a good personal medical insurance plan, you should do it. The benefits between your personal plan and your group plan are not necessarily any significantly different. But what can happen is that what it does remove is the gaps that may happen when you change jobs, and particularly when you have a gap that happen, or you may in fact change jobs and realize you cannot get any coverage, because when you apply to get group coverage by your new employer, the company may say you have a 1212, let's say an exclusion. We will not cover particular risks, or we may not provide coverage to you because you're diabetic, you have hypertension, you've had a heart attack before. You can end up with effectively no coverage, because you may not be able to get onto an employer plan. And because of that gap and those risks that you now have, because you have not maintained a personal plan, you are fully exposed to the fact that an insurer may decline you coverage. Okay. Typically, a group plan would include the same things as a personal. It would include your basic drug benefits, your hospitalization, your maternity benefits. In some cases, the plan may include things like physiotherapy, psychotherapy. Some may in fact pay a portion of your gym fees because they're into wellness. Some plans, both personal and group, may specifically provide a rider for things like cancer or diabetes care or for hypertensive care. Others may have very limited coverage in terms of that. The other thing that's really, really important in terms of medical insurance coverage from my perspective is to look at the lifetime limit of coverage. There are many plans in the marketplace on personal and group that have a limit of as low as $250,000 or $500,000, and in particular with those of us who may be a little bit longer in the teeth. When you hit 60 and then 70, you might see your lifetime limits decline from 250 or 500,000 to 250 down to 100,000. For me, that's counterintuitive. This is when I need it most, right? But look for plans that are providing you limits of $1 million or $2 million, particularly if you have a family history or risk profile that includes stroke, heart attack, and cancer. Because those are, or if there's a history of, say, for example, people needing things like organ transplants. Organ transplants are expensive. Potential long-term cure for stage 3, stage 4 cancers can be very expensive, depending on the nature of the cancer diagnosis. So that limited liability is really, really critical for you to understand. And when we look at it, when you look at it in terms of pricing, between going from $500,000 to $1 million or $1 million to $2 million, depending on the insurance company, there is not a significant change, no more than, in some cases, 10% between the premium that will provide you coverage for $1 million to $2 million. And it goes back to what I talked about earlier about the expected frequency and dollar value of claims. Very few, there are not going to be that many people in a medical insurance plan that is going to breach the $500,000 limit. Fewer would breach the $1 million limit, and they're not even fewer will get into what we call the layer between $1 and $2 million. But for your peace of mind, when you're looking at insurance coverage, medical insurance coverage, take the highest limit that you can afford, especially when you look at your family history. Okay. All right. Any questions on that section before we move on? All right. So managing your business. Some of you are business owners. I know there are lawyers on the call. There are some accountants. There are some general business people. And there are some insurance agents who, believe it or not, are, regardless of the fact that they're employed by an insurance company, they're in fact still, in my mind, individual business people. Okay. So key to be effective in business is understand why a customer will buy something from you. Communicate to them frequently and clearly. Be accommodating to their needs. Okay, those are the 3 positives. Be very careful with customers who start to make unreasonable demands from you, because ultimately that will cost you revenue, and it will cost you staff, and cost you reputation, and in some cases it might cost you a friendship. Right? So do not be scared to fire your clients, okay? Because the relationship that you may obtain after breaking that professional relationship may be stronger than when you were in that professional relationship. Do not get into business who compromise your personal ethics or who do not treat your staff well, right? Proper customer management ensures that you're paid constantly. One of the guys I worked for in Bermuda said to me, the best thing I ever heard about as far as a customer was concerned. He said, Colin, a customer is someone who buys something from me and pays for it. Okay? I know a lot of businesses in Barbados struggle with accounts receivable. because a person buys something from you, but they do not necessarily pay for it. Because when someone owes you money for 30 days, 90 days, 200 years, 2 years, that is not a customer. Okay, that's a relationship that you should probably sever, because maintaining that relationship costs you and your business and your staff money. Okay. When we get to financial management, I'm very simple. I'm a very simple guy when it comes to financial management. I'm an accountant, and one of the things I don't like my clients to get hung up on is the nitty too far into the woods with their accounting. Right? It becomes a distraction. It becomes a distraction of managing the customer relationship and your operations. So very early in your business cycle, what I expect and I counsel my clients to do, let us understand what are the key things that you need to understand about your business. What are the key drivers to your business? Right? So from an accounting point of view, accounting practice or a legal practice, what are the billable hours I need to generate annually to meet my financial revenue goals? Okay. The other metric we use from an accounting practitioner's point of view is something we call recoverables or recovery rate. So I might be able to bill 2,000 hours, but practically I can only collect or spend 2,000 hours in terms of generating work for my customers, but I may only be able to bill the equivalent of 1,600 hours, right? But that's a key measurement in my business. A lawyer may decide, I need to make sure I do 10 real estate deals with a value of $5 million to earn my based on the minimum scale of fees. I need to do 30 powers of attorney. I may need to do 5 estates at a total value of, or face value of another $5 million. And that will give me my estimated revenue goal of 200,000, 500,000, or whatever have you. An insurance agent might say, but you know, I have trailing commissions based on my existing business. And in order to meet my financial objectives for this year, I now need to generate X amount of new premium or generate X amount of new loans to my customers in terms of either mortgages or personal loans, or I need to sell X amount in terms of mutual funds or new mutual fund sales to generate that anywhere from that $75,000 to $300,000 or more of revenue that I need to maintain my lifestyle as an insurance agent. And it goes down the line from your retail person to your wholesale person to your entertainer. Entertainment might decide, I need to perform, I need to do 30 local performances during crop over. That will yield me X amount. I need to be overseas for another 3 months. That will yield me X amount. But it all goes down to planning when we go back to your rituals of wealth in terms of doing your plan and doing what you enjoy. But it also comes down to understanding the things that drive your business. So your principal driver of your business is your revenue, your costs and expenses. Okay? So 1 and 2 are the 2 critical things that I like my clients to focus on: the financial measures and the non-financial measures. And non-financial measures would be things, basically, as I just said, the number of events or the number of policies or the volume of policies that you need to sell and to meet your revenue target. The other thing that is important to me as an accountant And it's one of the biggest failings in the marketplace in Barbados, particularly because 80% of the businesses in Barbados are MSMEs. And it's to keep your books up to date. And if you're going to make the investment in your equipment, your staff or whatnot, make a very small investment if need be. Not need be, because you should in your basic accounting software like Xero, QuickBooks Online, or Soho Books. The subscriptions of these run anywhere between $20 to $30 to $40 US per month. If you can spend 30 minutes a day on just recording your bills and making sure you invoice your customers on time and reconciling your bank statement, for 80% of the businesses who are MSMEs, the accounting using simple software, these, at least these three and some other types of reasonably priced accounting software will keep you up to date, right? Avoid letting the volume build up to a month or 2 months worth of backlog. As soon as you, every morning, sit down, first thing you do, put your bills in, okay? If you completed something, bill your clients. And you'll find that it is a simple discipline, it is not overbearing, and it's something that actually becomes quite inexpensive rather than you having to hire a bookkeeper to do it yourself if they have to do the cleanup. By all means, have someone come in and do a quick review on a quarterly basis and on an annual basis. Okay? Consider when you get over $1 million or $2 million, hiring a professional bookkeeper to do a lot more of it, or look at things, or you may consider getting someone, look at a couple of the people who offer payroll services to do your payroll for you. Take the pain points away from your bookkeeping for yourself, because you want to concentrate on item 1 and item 2, but you need item 3 in terms of being ensured that you can meet your targets. Okay. The next stage of this, in terms of financial management, do not overanalyze. One of the trends that I've seen in my profession over and with people who are non-financial are managers with a non-financial background, they get tied up into the details, right? The objectives, to my mind, are the most important thing that you have to satisfy. What are the goals I'm set out to meet? Go back to our 5 rituals now. What is my plan? What are my objectives? Go back to your pension and your estate planning. And all of these roll right through in terms of your attitude of your financial management. I worked for a bank in Canada, and I was astounded that all they were concerned with on an overall basis when it came to financial performance was 4 key numbers, right? And they were interest or income, interest expense, non-interest revenue, and operating expenses, and of course, net income. They ran a $215 billion company by focusing on those key numbers. What we found internally within our finance group is that some of the non-financial managers but had line of business responsibility spent a lot of time trying to analyze every line item in the financial statement. And it became a distraction in terms of focusing on the key goal, the 2 key goals, driving revenue and customer acquisition, and driving overall profitability. So the key things I like to my clients to look at: what are your revenue? What are your costs of sales or costs of revenue? What is your gross profit? What is what we call controllable expenses, things like your salaries and wages and whatnot. And at the macro level, not trying to drill down to the individual line items. And then there are things what we call non-controllable expenses, or the things that you literally have to do every month to keep the business turning. Paying your light bill, paying maybe paying dues or whatever to be part of a professional association or whatnot. But split your expenses between the things that you think you have a measure of control over. You can determine the timing and the value of those expenses, and the non-controllable expenses, which are things that you must do. The other key things for me that I focus on, and I encourage people to use your financial ratios, but make sure the application you choose to do your accounting can produce that ratio, those ratios for you without you having to do anything. So your inventory turnover tells you how often your inventory is moving. Your accounts receivable days of sales outstanding, that means how long does it take you to collect your money? And you want to get that down to 5 days or less. This 30, 60, and 90 days create problems both for you internally in terms of cash flow, and it drives your need to finance your business. And then your accounts payable days to pay. Your accounts payable days to pay should never be shorter than your receivables days in receivables. Because if your accounts payable days to pay is shorter than your receivables collection cycle, you will always be out of cash or always be in need of some form of financing. So the two of those you manage together, and the other thing, your inventory turnover, you also manage aggressively, so your inventory is turning on a regular basis. You don't have either overstock conditions or out of stock conditions. Okay. The other component of it: do not purchase more assets than you need. Coming through from audit between 93 and 1991, I came across so many cases where you go by a client and the client has a lot of inventory. It may be inventory relating to the sale of goods, or sometimes simply inventory related to things like something as simple as stationery and supplies. I recently saw a situation probably where a client had, or organization was associated with, had something like stationery that they've had for 5 years or more that had not been utilized. And you end up with silly little things like you've paid for reams and reams of letterheads and envelopes that are no longer in use because you've redesigned your logo. You're now sending things out electronically on your letterhead. You don't use envelopes, or you seldom use envelopes. Those are things that are simple, but it can be a cost. But more importantly, when we look at a business in the wholesale or retail sector, any business that accumulates assets for sale, do not be fooled by a presentation that says, buy this amount of goods because the cost per unit goes from X amount to Y amount. It is a massive savings to you. And this is true especially for people who import goods into Barbados. people do not measure the cost of the interest that has to be paid on the inventory that is sold. So you buy $1 million in inventory, you're a retail business, you're bringing it in from, let's say, April, May, and the majority of your sales will happen in the 6 weeks between the last week of November and the first week in January. But you continue to pay the interest costs on that stuff. You run the risk of having to rent or build additional storage space because inherently, you know, I'm going to order a year's worth of inventory or 2 years worth of inventory. The biggest cost out of all, it becomes obsolete. So, classic example, around 1988, I was involved in a receivership of a garment company. When we went into that place, they had the production floor. The second floor was the administrative offices and design area. And the next 2 floors were inventory. Okay. What we found was a lot of dead inventory because the product they were producing became end of line, so they could not use the materials afterwards, or they did not repurpose it. And so they were storing and paying rent to keep stuff that they were not using or had no ability to use. And we went ahead to start advertise the sale of this stuff. And Customs came to us and said, if you're going to sell this, you have to pay the duties that had been waived because of this company's manufacturing status. Okay, so the prospect of having a successful receivership, liquidating the assets, paying back the bank and giving the business back to the person, or realizing the business assets to the person, was taken away because of the fact they had significant excess inventory, of which there was an undisclosed liability attached to it. Okay. The other thing that I caution people about is the purchase of vanity fixed assets. So an expensive executive or management vehicles. Do you really need to have the Jaguar or the Benz in this business to impress your client? Or is it because you really want to just impress everyone else? Right? Things that you invest in your business must be fit for purpose. Right? The other thing, and this is particularly in terms of guys who are into technology, they tend to always want the next shiny object in terms of technology. It may be in a bakery, it may be an IT place, it may be a retail store that's selling computers. That's not such a good example, but it may be an environment where everyone is saying, I want to keep up with the existing technology, but you have to be practical. Is keeping up with that existing technology going to be beneficial to your business? If it is going to be beneficial, certainly turn over the asset, certainly sell the other, make sure you can sell the other asset, at least to partially fund the acquisition of a new asset. But typically what happens in these circumstances is that when you turn around to upgrade the equipment before the end of the life cycle, there are no buyers, or the buyers that may approach you are looking for a bargain because they don't say the technology is outdated, right? The technology may be outdated, but you still have a useful life for it. And rather than terminate it at 3 years, take it to the 5 years and you are still at the cutting edge technology for another 5 years on the replacement, and you fully utilize the economic life of the asset, right? And the last point is avoid delaying replacement of operating assets. We saw it in the garment sector, we see it in bakeries, we see it in so many facets of business in Barbados and outside of Barbados, that a company may decide, I will not replace this asset. I'm going to try and get another 4 or 5 years out of it. But they do not take into account the downtime and repairs and maintenance on that asset. Okay, so asset management is really critical. Right. The last component of this on financial management for the business is having prudent debt management. Take on the amount of debt that is required for the company in terms of purchasing the asset, in terms of working capital. Work really hard with the financial services provider, to ensure they understand, if I say I want $100, I need $100, and not I need to work through or squeeze it out with $80. Because in many cases, a lot of businesses fail, or the cause of failure of many businesses is the fact that the financial institution did not lend them sufficient money to do what is needed, or were not willing to provide the drawdowns as required to the maximum amount, and you end up with out of stock conditions, you end up with relationships that compromise with your vendors, or you end up with issues with meeting your statutory obligations like NS and tax, right? On the flip side, do not hold more debt than you need by holding excess inventory to vanity assets, or something that has been prevalent in the Barbadian landscape of using company funds to purchase personal assets unrelated to operations. Okay, this means saying that people say, I go and borrow $100,000, but I really want $50,000 of that to go and buy a piece of land that I like personally. Do not mix your business with your pleasure. Okay, and then last one is have a dividend or periodic distribution policy. Make sure you know how much of your money you want to distribute from your business to yourself or to the other shareholders quarterly, semi-annually, or annually. Because once you plan for that distribution, you also inherently plan for your revenue and for your profitability. What I don't might mention here is access information with regards to the financial stats on similar businesses, things like the Canadian SME toolkit, which will give you the financial stats on a number of different companies based on the SIC codes, the standard industry codes. You can get that information, look in terms and see how do companies up to this particular value of revenue are performing. They're not 100% compatible with the realization in Barbados, but they provide the important benchmarks for you to consider. Okay, get something. If you're doing like planning, use a tool like Life Plan, which has embedded in it the ability to look up the financial stats for a variety of industries. Take that 2 or 4 hours to put a plan together, access that information, and try to track it within Life Plan. Life Plan will link with Xero and QuickBooks Online to pull the information into Life Plan, and allows you to do that ongoing comparison based on your business plan. Okay. I know I skipped to operations. Business succession planning. We're going to cover 3 areas: family succession, dissolution of business, and sale of business. Majority of the businesses in Barbados are family-owned businesses. It may be one person or two persons. We have had recently one of the oldest multi-generational businesses in Barbados sold, which was Collins Limited. Okay. Family business is a significant source of wealth, especially when it gets into the second and third generation. What you will find, it usually has a strong balance sheet that is consistent with what the operations are. The salaries and wages paid by the paid to the family members are in line with the industry. And they have significant value that is built up in terms of historical cash flows, historical profitability. However, most family businesses do not survive more than 3 generations, be it in Barbados or be it internationally. And this is the principal reasons are, by the end of life of that company, whoever is responsible for running the company will not relinquish real control. They will tell you, come into the business, help me with it, get you trained, and you can take it over. But they will not move on. There's usually a lack of planning for succession. Then the other one is that if family members, after the second generation and third generation, are no longer interested in the family business being their destiny, or they just fail to identify a family member who may be interested in taking control of the business, but perhaps has never been involved in a business, who is working for someone else or working in another industry, and they've never considered that person to be an appropriate person to come and take on that business. Okay. The businesses that have been successful in Barbados multi-generational has been Goddard. The BS&T group, as we saw by the end of the 1990s, ended up being sold almost completely out of the ownership of Barbadians. You've had the recent sale of Collins. I don't know what the structure of that sale may have been. For all I know, they may have sold 80% and maintained 20% interest in the business, because the business at bottom is what we would classify as a strategic buyer, which allowed the combination of their existing business in Trinidad and the rest of the Caribbean, and added it to the business of Barbados, of the Collins operation in Barbados and their Caribbean. We saw a strategic sale by the ITC group, the Simpsons group, about 5 years ago, when Saul, 5 or 8 years ago, when more than 8 years ago, when Saul was sold to Parkland Oil in Canada, and they took back a 25% interest in Parkland as part of the proceeds of the sale, which meant that in addition to earning money and participating in the profitability of Saul Caribbean, the family who controlled ITC were able to benefit from their participation now in Parkland Oil, which is operating in the Canadian market, a much bigger market than the Caribbean market. And then again, this year was a sale of Simpson Motors to a British automotive company. And again, the terms have not been disclosed, other than the fact that the acquiring company said it should earn at least another $120 million in terms of revenue from that acquisition. I would suspect, and the family did say, we are exiting to pursue other ventures. It does not necessarily mean that they have sold 100% of that company as well. So by taking up maybe 10% or 15% in exchange for the sale of Simpson Motors plus cash, they have actually increased the value of the holdings of that business. But the principal reason why a family will sell all or part of their family business is to unlock the wealth that they cannot access unless the sale happened. Back in the late 80s, Goddard's Enterprises did it by offering Class C shares into the marketplace, which allowed them to unlock part of the built up wealth in the company through a public offering of shares. They were able to maintain a level of control because the Class C shares were non-voting shares, and they were able to get additional funds into the business, withdraw some of the wealth, but also continue to build to expand the business worldwide. Okay. In terms of succession planning, you want to look at internal management. You want to start the process of planning for succession early. If you're the principal, at least 5 years before you want to leave the business, you have to start your succession plan. You want to identify the family members who are interested and capable of running the business. You may also want to install a professional team of managers who want to continue the business, or install a board comprising of the family and external professionals to govern the business. All of this does is to strengthen your business and build the value of the business going forward. Okay. In terms of the potential sale of the business, you want to identify potential external parties who you may want to approach to sell the business to on a confidential but competitive basis. You want to have a management. You may consider approaching the management team to ascertain their interests and capability of buying the business out. To my mind, they are usually the best group to consider first. And also consider family members who are not participating in business actively, but are, let's say, advisory board or part of the team that constantly discuss the business and say, we want to take in a different direction. Classic example, what will happen if Shafak decided to make a change? I know we've always heard there's some interest in particular, some family members want to take the company in a particular direction, but because the principal is a dominant force in the business, he wants to stay in a particular course, right? And ultimately, the parties who may be in the business or who have an interest of moving in a different direction, they say, Guy, you're coming up to retirement, or you should retire. Let us buy you out, because we believe there's more value in the business if we take it in this particular direction. Unfortunately, majority of family-owned businesses by the third generation are dissolved. Okay? Some of them are dissolved passively. A lot of us can walk about and see a number of shops and mini marts and whatnot that existed when we were children, who are now closed down because the father, the mother, the grandmother, whoever ran that store did not have a succession plan. And when that person died or said they had enough, they just stopped trading, right? That's a passive way of stopping doing business in Barbados. Alternatively, if they have good advisors and they're planning ahead in terms of what they're going to do, they may decide, I'm going to liquidate the assets, liquidate the business, I'm going to sell the assets, I'm going to settle all the liabilities, and then just going to shut it down and go home. That unlocks some value, probably sufficient to take it to take the owner into retirement, but it does not generate the multi-generational wealth that we have seen with companies like Goddard's, Collins, ITC, and others. Right? If the business is conducted through a company or SRL, a society with limited restricted liabilities, you should properly dissolve the company. Right? If you don't, you end up in situations where you have continuing liabilities and continuous statutory reporting requirements like your annual returns and the filing of corporate tax returns. So if you're going to just roll up the company, make an active decision that you are going to cease business properly, liquidate the company, and dissolve it. Okay, right? Once you dissolve the company, the things that you just need to follow through on, you notify the Barbados Revenue Authority, National Insurance Department, and if you happen to be registered for Customs and Excise, you notify them. You should also make sure you close all your financial accounts with banks and other institutions that provide services to the company, the business. In Barbados, the Caribbean, Southern, Central, and Latin America, Europe, and the majority of the world, most businesses wind up. They're not sold. In North America, probably about 40% of businesses that are in operations are sold, and about 40% of the businesses in North America are driven through, are related to some franchise operation one way or another. And those are things which are valuable and always considered for sale, available for sale, or interest in people purchasing it. So we have a couple of stages in terms of when you're preparing to sell the business. Again, having an idea in terms of how you intend to transition away from the business. Family members are not interested. The business has a locked-in value. You want to realize that value. Set a time frame of anywhere between 3 to 5 years to prepare your business for sale. The first step is to get your initial valuation. The second step, as far as I'm concerned, look at the business processes that need to be improved and execute that improvement plan, because what you want to do in those last 5 years before it is sold is to really drive and increase the profitability. On the financial side, financial management side, on the operations side, clean up all your statutory filings, your CIPO filings, your tax returns, make sure your minutes of your board meetings are complete and comprehensive. Just your overall governance. You want to put the business in a saleable condition, make sure what needs to be covered by the different classes of insurance are properly covered. Make sure your contracts with vendors and customers are in place, and make sure you have proper contracts in place for your staff and the bargaining units if applicable. The second stage is to engage a business broker or M&A advisor, merger acquisitions advisor. You want to create a list of potential buyers, strategic or financial buyers. Strategic buyers are people who will want to consider the business combined with theirs to make the two, make 1 + 2 = 3, 4, 5, or you have the financial buyers who just think that is an opportunity to further optimize the firm and sell it down the line for a much bigger valuation. Your internal management are another source of potential buyers. and of course your competitors. You create an offering document and you market the business to the target list confidentially, right? If you've hired a business broker or M&A advisor, you want to ensure that part of the process that they're doing is they're going to look at their existing customer base, being people that they sold businesses for or bought businesses, or who bought businesses through their network, because that's a good source of potential purchasers. A lot of people are serial entrepreneurs. They have a broad interest in the type of businesses or a portfolio business, so this should be actively marketed in their database along with externally. You might want to advertise it on sites like International Business Broker Association or Business Broker Net, and of course a small display ad in the newspaper saying business for sale, contact XY person for the confidential information. You make sure you get your NDA signed, NDA non-compete signed, and then you can have a more active discussion. Right. Stage 3, you want to review at least 3 competitive bids. You consider the ability to finance the purchase, the character references or personal relationship of the potential buyers, the price they offer, and then from there you actually start to negotiate and you close the sale. And the final stage of this is the structure of your payment, preferably 100% of completion. You have to consider if there are any property transfer tax or VAT components in the transaction, and if it's an asset sale, or sale of shares in the business, not sale of property, but sale of shares. So, for example, if I sell a retail business that has inventory, and it's an asset sale, which means I'm just selling the assets from one entity to another, it's going to trigger value-added taxes on the inventory. So part of the proceeds, you're going to have to list the assets by type, assign a value to that. If it's inventory, you're going to have to pay VAT on those, and that becomes a output tax. But of course, you can then, and you probably have already claimed all your input taxes on that already as you acquire the inventory. The asset sale, the sale of things like fixed assets may generate a gain or loss for tax purposes on the disposition of those assets, which then become taxable within when the tax return is filed. Okay. On a sale of shares, the shares may in fact become subject to property transfer tax. The same way that if you had real estate as part of the sale, it would attract property transfer tax on its own. If you are well advised, some of these taxes may be avoided. For example, the bidder may decide we're going to do a business combination, which is done under amalgamation. And then once that amalgamation is completed, a special dividend is paid out to the former shareholder and shares redeemed, and they will be subject to dividend taxes on the amount they receive as dividends, but for the redemption of shares are not necessarily subject to taxation. And the last part of it, we're coming down to the end, wills and estates. Basically, a will defines how a person wishes to distribute its assets to its successors, or heirs. The Succession Act governs the minimum standards when met for the distribution of an estate to the spouses and children of the testator. Basically, the wills and last testament instruct the courts on how assets subject to the will are to be distributed. while it's the foundation of the estate plan, it is not the only instrument that can be used. Okay. When property, particularly real property, is transferred via a will through what we call an assent from the testator's estate to the beneficiary, there's typically no property transfer tax paid on that. And that is one of the things that can become quite complex. Again, when you're planning your will, it's part of your estate. If you intend to leave real estate, one of the things that you must do, retrieve your property documents, your conveyance, your purchase and sale agreement if applicable, or the registration of title if the property has been registered by title, and put them in a safe place or deliver them to your intended executor. Do not leave those documents in a safety deposit box with an attorney who is of your age, right? They may die before you or die with you. So you want to make sure that the instruments that are necessary to determine that you are the executor has been appointed and the executor has the tool to control the assets, or with the executor or accessible to the executor. So if you want to keep them in a safety deposit box, get a safety deposit box of which you and the executor are the parties to that safety deposit box. Okay, it means they can go in there, retrieve the will, retrieve the documents relating to the ownership of real estate, any instructions with regards to bank accounts or whatever. That executor needs to know what is in the estate and as defined by you, and not have to start to scramble to find the documents before they can go to probate, because sometimes it takes a year, 2 years, 3 years before all documentation is available for the executor to take them to the court and start the probate process, because they do not know what the estate comprises of. So early in the session, we talked about your estate plan. That estate plan should always be updated in terms of assets, liabilities, insurance policies, and whatnot. So one of the things that's not included in a will, unless it is defined, unless the insurance policy is defined to the estate, is any insurance policy that has one or more named beneficiaries. Any person who is has a joint account with the party which is structured in the form that party automatically becomes the owner of the account is not part of the will. So if you have an intent that there are going to be funds in a bank account that are to be distributed to several beneficiaries, work with your bank to ensure that it is either tenancy in common or joint tenancy, whichever one that says that the bank account is literally the owner is owned by the testator, or the other party to that bank account really and truly only has the ability to access that account under the power of an attorney. Okay, once it's under power of attorney, as we know, power of attorney dies when a person dies. It means that now, in order to access that bank account, probate must happen, and the executor then gets control of it. But the account cannot be utilized by another potential beneficiary or another party because they had tenancy in common. So if you want the cash to be transferred, make sure you take the steps to ensure the bank account is secured in a manner that it passes to the estate. All right. Trusts are another method of passing assets. Yeah, the Succession Act covers both these situations of wills or when the person is intestate. So if there's a will, the executor would apply for letters of testamentary. If there's no will, the administrator would apply for letters of administration. But in each case, it gives the right to the person to wind up the estate and distribute the assets of to the beneficiaries. A trust is a creature of common law, right? And it allows the settler of assets, a person who owns a set of assets, to transfer that property from themselves personally into trust, and that trust is managed is managed professionally. The beneficiaries are defined in that trust, and any type of assets can be in that trust. You can have the trust owning a fixed insurance policy if that's amenable to the insurance company, real estate, bank accounts, mutual funds, any class of asset that we discussed earlier. Okay. What you must be mindful of is that when you transfer assets from an individual to a trust, particularly things like real estate or shares in a company, that can trigger property transfer taxes. Okay. But at the end of the day, sometimes depending on the size of the estate, you may suffer the consequences of the property transfer taxes to reduce the impact of inheritance or other estate taxes, particularly in a case where, let's say I'm a Barbadian, I own real estate in Barbados, I have a business in Canada, I have real estate in the US, I might have assets in various jurisdictions. One of the recommendations, if you have assets in different jurisdictions, is also have a will that will be probated specifically in that jurisdiction against those specific assets. It avoids the issues of trying to having a will that's probated in Barbados, reprobated in another jurisdiction. Okay. A trust can also determine how the assets are managed during the lifetime of the settler. Okay. It can protect assets against from creditors, and you can dictate the terms to the inheritance. Right. It takes time and money to create a trust, and they're not easily revoked. Some trusts may only last 50 years, some may last 100 years, but in some cases, the legislation, depending on where you are in the world, will allow you from a trust to transfer the assets from itself when it comes to end of life into a new trust and preserve those assets for multiple generations. Okay. And the last issue I want to talk about is just the transfer assets. The biggest asset in Barbados typically is real estate. I'm sure many of you have had situations where the asset becomes contentious, or you have a situation where you have a mother leaving a property to her children, and then one child then leaves their share of that piece of real estate to their 3 children. And because the estate has not been properly probated or promptly probated, you may now have a situation where 30 years later or 40 years later, you're attempting to probate a a will and divide the assets, and you're finding that something that was simply said, that was simply left to two siblings, and they now have siblings and their children, you're going 8 deep or 10 deep or 12 deep in terms of that asset. So I want you to consider a few things if you have real estate, in particular, if you want to vest to your family members. Subdivide it prior to death, right? Consider gifting the real estate to the proposed beneficiaries. While you may have to pay some property transfer taxes, it is clear-cut as to what it will cost, and there is no dispute between the members. It is gifted, the conveyance is properly prepared, and the transfer between the owner and the beneficiary is absolute and transparent. Any other financial assets that you might want to give, do that. Anything like jewelry, do that. Why, if you know that, let's say you have cancer, you have 2 years to live, you have 6 months to live. I am very pragmatic. Distribute the assets then. Have the conversation with your beneficiaries then. Okay? People understand why you want to give them X, Y, and Z. You don't want to get in a situation where you have an executive that you find out that, or the beneficiary finds out that when they see the will, the person who's named as executor has already predeceased the testator. Those are the type of things that end up happening that cause problems when wills are probated. You find out there's an executor who is unwilling. The executor may have died. You find that you have a piece of land that's supposed to be left between 4 people, and there's no subdivision. You have to go through the expense of subdivision, and it's not necessarily known if the subdivision permission may be obtained. People might decide, well, I will want to buy out these other 2 beneficiaries of this piece of land, which also then creates another type of issue in terms of the settlement. You have 4 parties. One wants to buy all plots. One person said, I'm not budging. And as a result, the benefit to the beneficiaries cannot or will not be realized. The other thing is you transfer your shares in a personal business, if you have it, and also have a power of attorney at least that can act for you during an illness or when you're away from the island. Okay, but the critical thing in terms of estate distribution is to have a plan that goes back to your estate planning. Consider the nature of the assets. Consider your beneficiary. Consider who you want to be your beneficiaries, and also understand what are the needs of the beneficiaries. You may think you want to distribute land to them, but the person may have decided, I have more property than I want. I am no longer living in Barbados. They're no longer living in Barbados, so they're really not interested in the property in Barbados. They have needs in terms, I want to pay for university education for my child. You've left me property, and the estate is not in a position where I can easily transfer the assets, or that I can easily use the asset as security for the loan. And the goals and objectives that you may have laid out in your estate plan also then conflicts with the goals and objectives that a beneficiary may have laid out in their estate plan. So a lot of people want to surprise the beneficiaries when they die. But one of the best things, to my mind, to do, consider the transfer of your assets, consider the needs of your expected beneficiaries, your needs and requirements of the existing beneficiaries, and dispose or reorganize your final distribution of your estate along those lines. It reduces the strife in the family unit regarding how things are passed with beneficiaries. Okay. And that is the end of my presentation. I welcome any questions you have. Hope it was informative and enlightening and not too boring. And I hope I've been able to convey to you some of my thoughts when it comes to estate planning for estates, pension, and overall financial management.
Thank you, Mr. Daniel. I'm just checking to see if there were any more questions. We don't have any more questions. Thank you so much for your thought-provoking presentation on financial and estate planning, and thanks for taking time out of your busy schedule to brief us on a topic that is very much needed in today's environment. And we want to thank everyone for also attending this session this evening. The session will be available for viewing on YouTube. We have a comment here saying that it was very informative. They came in late, but they'll listen to part of it again. Yes, so it will be available on YouTube after. If you have any questions, you can always contact the CSI. We have another comment here saying that it was fantastic and thank you so much. So,
Hi, Sharita.
Everyone in the presentation. So thank you so much. Thanks once again, Mr. Daniel.
You're very welcome. Thank you.
Yeah. All right, so have a good evening, everyone.
Thank you. Have a good night. Sharita, how are you?
I'm fine, thank you. And thank you so much for that. I learned a lot. We needed that.
Great. Good to see you again. Okay.
Likewise.
All righty. Alan, how are you?
Family members, all praise and to God be the glory. That is so pointed. That is so much on point. You know, we all are different, gifted.
Very nice, Colin.
Thank you. That's Lisa?
No.